I'm Jarrad Brown, financial planner to Australian expats in Singapore and around the world. Welcome to my video series where we explore the key personal finance topics for Australians at home and abroad. Today we're talking about withholding tax and what it means for Australian expats in Singapore. One of the most common misconceptions and myths that we see floating around amongst Australian expats is that if you buy managed funds or Australian shares while you're a non-resident of Australia for tax purposes, that you'll need to pay Australian capital gains tax. Now firstly, this is not true. The tax that we need to be mindful of when we're buying Australian shares or managed funds is withholding tax. Australian residents are required to withhold tax whenever income or dividends are paid to non-residents of Australia in one of three categories. This is bank interest, dividends from shares when the dividends are unfranked, and royalties. So let's get into exactly how these rates work. The withholding tax rates that apply are 10% on bank interest and 30% on unfranked dividends. Now, if you're not sure what an unfranked dividend is, this is when the company hasn't paid corporate tax on that portion of income before distributing it to you as a shareholder in the form of a dividend. Now, these rates will apply unless there is a double tax agreement between your country of residence and Australia. So let's explore how it works for Australians living in Singapore. As Australian expats living in Singapore, the rates that are going to apply to us are 10% for bank interest, which means that if you earn 3% interest for the year, the bank's going to withhold 0.3%, and 15% on unfranked dividends. Now do note there is no withholding tax on fully franked dividends, but nor do we get the franking credits. Now one way to avoid withholding tax altogether is obviously to just avoid either unfranked dividend paying companies or avoid Australian shares altogether. There is no one-size-fits-all approach. As Australian expats living and working abroad, most of us are going to either live, work or retire or all of the above in Australia at some point in the future. So for the majority of us, we're going to be accumulating at least a reasonable portion of our wealth in Australian dollars. Now this means a reasonable portion of our investments are probably going to be in Australian companies. We therefore need to be mindful of what investments are paying either fully franked, partially franked or unfranked dividends and what impact this has on our overall return. There are also strategies you can adopt, such as selling dividends prior to record dates, but this is a discussion we can explore and have offline. If you have any questions around whether your dividends you're receiving are franked or unfranked and what your options are, feel free to reach out to me on the contact details provided. Likewise, if you have a personal finance question or topic that you'd like me to explore, reach out and let me know and I'd be more than happy to consider it. Thank you and see you next time.